Hey everybody, it's Rob Bruner at Valtins & Bruner Financial Planning. Today we're doing another session of Sketchpad Simple. Today's Sketchpad, we're going to talk about the top of the 12% tax bracket. This is a sketch we do in client meetings to explain how we want to take retirement withdrawals up to the top of the 12% bracket, but try to avoid the 22% bracket. So here's what I mean when I'm talking about efficient retirement withdrawals or Roth conversions to the top of the 12% tax bracket. In our federal tax code, we have some income that's taxed at 0, some at 10, some at 12, some at 22, and we have some tax brackets above there. We also have what's called the standard deduction. So for single life, that's $12,950, and for married filing joint, we have a standard deduction of $25,900. For this purposes, we're just going to talk about standard deduction. There is also the option of itemized deductions. So your first chunk of income is taxed at 0 because we have these standard deductions. And then we have the 10% bracket. For single, that goes to $10,275. For married filing joint, goes to $25,550. And then we have the 12% bracket. That goes to $41,775. And for married filing joint, to $83,550. So when we look at this, we're looking at it and saying, okay, so over time, we want to efficiently withdraw from taxable assets within the lower tax brackets if we possibly can over your retirement. So we know we've got a chunk of income at 0. We know we've got a chunk of income here in the 10% bracket. And we know we've got a chunk of income here in the 12% bracket. And we know this line, when we go above this, we're jumping from 12% to 22. Now here's the trick question. Is that a 10% increase in your tax, or is it really more? So if I have a dollar that's going to be taxed at 12%, or I have a dollar that goes over this line and is going to be taxed at 22%, that's really an 83% increase in the tax on that $1. So it's a big leap from a taxation standpoint between the 12 and the 22% tax bracket. So when we're talking about efficient retirement withdrawals, what we're looking at is we're saying when you're taking money out of retirement accounts and you've got an IRA, which is pre-tax money, you might have a 401k, which might be pre-tax money. You might have Roth money. You might have a brokerage account where you just have some holdings in there. It's not an IRA or it's not a 401k or Roth. So when we're taking income out, we want to efficiently withdraw from these assets to give you your monthly income and try to stay underneath this 22% tax bracket if we can. So what that might mean in practice is we're taking withdrawals out of pre-tax IRAs up to this bracket, and then if you need more income, then the income above that line is coming from your Roth. So that's a way of taking efficient retirement withdrawals. On the flip side, if you don't need that much income, that's when we look at Roth conversions, where we look at you have an IRA account that's pre-tax. We may convert that money and pay tax on it and convert a chunk of that IRA into Roth to get it into a tax-free account going forward. Part of the management of this is also time. So we're in 2022, 2023, 2024, 2025, 2026, 2027, and beyond. If we look at this and say we want to manage this over time, we're not just looking at it in a one-year time frame. We're saying we got to manage this over your whole retirement and efficiently take those withdrawals out. And that's part of the planning strategy where tax is a really, really important part of that planning strategy in retirement. So if you have any questions about this, please contact our office. This is our phone number and our website, and you have most of our email addresses. And just shoot us an email or give us a call. If you have any friends or family that are nearing retirement or retired and looking at efficiently withdrawing from assets and making those assets last as long as you possibly can, please have them get in touch with us too. Thanks and have a great day.